Hey everyone, we need to talk about what just happened in silver, because this is not a normal little Monday morning wiggle. As I'm recording this, silver is sitting around 79.56 an ounce. In the last day, it's up about 2.4%. That's roughly a $1.87 move. If you own, say, 1,000 ounces, that's about $1,870 of swing in a single day. And gold? Gold is positive too, but it's acting way calmer. Gold is around $49.89 an ounce, up about 0.47% on the day. So why is silver exploding while gold is basically just drifting higher? Because moves like this usually aren't about one headline. They're about positioning, fragile liquidity, and a market that's been leaning the wrong way, and then suddenly gets forced to reprice fast. What you're seeing isn't the mainstream explanation. Let me show you the three things happening right now that make this move in silver feel a lot more dangerous, and potentially a lot more important, than people realize. We're not looking at typical volatility here. Here are the three factors that converge today. First, silver is doing that thing it loves to do. It moves like a metal, but it trades like a high beta risk asset when the market gets uncertain. That means once it starts running, it can snowball. It's not just some buyers showed up. Silver has a history of turning a normal up day into a squeeze-style move because the market structure is thinner, the positioning is more crowded, and the reactions are faster. Today's day range is wide, and when you see silver pushing up while gold is only inching higher, that's often your clue that this is not purely a safe haven bid. It's also about traders scrambling. Second, the gold story in the background is still very real. Central banks have been steady buyers, and China in particular has been a consistent theme. Even when the price action is choppy, that official sector demand creates a psychological floor under the entire precious metals complex. And here's what matters for your day-to-day trading reality. When gold has that bid underneath it, silver often gets pulled along, but with leverage. Gold can be up 0.5%, and silver can be up 2, 3, 4% because silver is where people reach for more juice. Third, the macro backdrop is still loaded with rate path uncertainty. The Fed may hold, but the market doesn't just care about what the Fed did, it cares about what the Fed will do next and whether the economy forces their hand. When traders get even slightly more confident that rates aren't going to keep crushing liquidity, silver reacts aggressively, and when that narrative shifts even a little bit, when the dollar softens, when yields calm down, when tight money forever gets questioned, silver can jump first and ask questions later. Now put those three together. You get a market where gold has structural sponsorship, macro uncertainty is high, and silver, because of its personality, becomes the instrument that gets repriced the fastest. That's why days like this matter. Not because I'm here to scream buy or sell, but because when silver starts acting like this, it tends to reveal what's happening under the surface in liquidity and positioning. And the next phase, whether this move fades or turns into a bigger trend, is going to be decided by a handful of levels and behaviors that most people are not paying attention to. Institutional money saw this coming. Let's start with the institutional layer because this is where most retail investors get tricked. They look at a one-day move in silver and they think the news caused it. Usually the news is just the match. The gasoline was already on the floor. A big part of the gasoline in precious metals is official sector demand, central bank behavior. When a major buyer keeps showing up month after month, that changes how money managers treat pullbacks. Instead of, this is the start of a collapse, dips start to look like opportunities to rebalance, rebuild exposure, or hedge something else that's getting ugly. And here's the key point. Even if the central bank is buying gold, the ripple effect can hit silver hard. Why? Because portfolio managers don't just buy gold. They buy the precious metals basket, they buy miners, they buy silver proxies, they buy options. Silver becomes the high volatility cousin that moves the most when the tide comes in. Another institutional layer that matters is how quickly the futures market can flip. Silver is notorious for fast repositioning. When traders are leaning short and the market doesn't go down on schedule, you get forced buying. Not because people got bullish, but because risk managers demand it. Cover the short, reduce exposure, don't get carried out. And that forced buying has a signature feel. Gold doesn't need to move much, but silver suddenly looks like it has a rocket strapped to it. There's also a psychological institutional behavior. When gold is near big, round, highly watched levels, it becomes the anchor of the whole space. Gold doesn't have to go vertical. It just has to not break down. Once gold is stable, silver becomes the playground for risk. Now, I want to be clear. None of this guarantees continuation. Institutions can be early, they can be wrong, and silver can reverse violently. But days like today tell you something important. Somebody with size was willing to pay up for silver. And in a market like silver, willingness to pay up is not common unless there's pressure behind it. So the question becomes, where does that pressure show up in the technical behavior? So I pulled up the chart this morning, and here's what jumped out at me. Silver is around 79.56 right now, and the day's range is roughly from the high 77s up into the low 82s. That's a huge range for a normal day. That tells you we're not in a sleepy, orderly market. We're in a market where people are getting surprised. Here's why that matters. When silver can trade through multiple dollars in a short window, it means stops are getting hit, margin is getting tested, and weak positioning is getting shaken out. In plain English, people who were overconfident are being forced to react. Now, the first big psychological level everybody watches in silver is $80. Not because it's magical, but because it's human nature. Round numbers become magnets. They become battlegrounds. If silver can hold near 80 and start to build acceptance above it, not just spike above it and collapse, that's when you start hearing the words new regime and new floor. On the flip side, if silver gets rejected hard from around 80 and slides back into the mid to high 77s, that's where people will say, see, it was a fake out. And those fake outs can be brutal because they trap late buyers. So what's the level I'm watching? I'm watching whether silver can stay constructive around the upper 79s and low 80 area without giving it all back. Because in these fast moves, it's not the spike that matters. It's the behavior after the spike. Does it hold? Does it drift down slowly? Or does it slam lower? If it slams lower, that usually means the move was mostly a positioning event that ran out of fuel. If it holds, that usually means the market is repricing, not just squeezing. And here's the part most people miss. Silver can be up 2.4% in the last day and still be in danger. Because when volatility expands, the next swing can be just as big in the opposite direction. So you don't treat this like a normal trend day. You treat it like a risk event. You respect that the next decision point could come fast. Now let's connect that to fundamentals. Because silver is not only money, it's also a critical industrial metal, and that dual identity is exactly why it behaves like this. Now let's talk about the fundamentals, the real supply and demand picture, and I'll keep this simple. Gold is mostly about monetary trust, central bank policy, and fear. Silver has that monetary side too, but it also gets consumed. It gets used up. It goes into things that don't come back easily. Silver ends up in electronics, solar panels, industrial components, and a lot of systems where the amounts per unit might seem small until you scale it up across the world. That's why silver can have these moments where it stops trading like a quiet precious metal and starts trading like a strategic input. And here's the critical part. A lot of silver production is tied to other metals. Silver is often produced as a byproduct, so if the primary metal slows down, if industrial activity changes, if miners cut back, if economics shift, silver supply doesn't smoothly respond. It can get tight at the wrong time. Now combine that with what happens when investment demand wakes up. If investors decide, even temporarily, that they want more exposure to precious metals because they don't trust the currency path, they don't trust the rate path, or they want an insurance policy, silver can feel like it disappears fast, not literally vanishes, but the available liquidity at the margin dries up. And then the price has to jump to find sellers. That's how you get a day where gold is up less than 0.5% and silver is up over 2%. It's the same story you see in other tight markets. Copper, cocoa, natural gas. When the market is thin and the narrative flips, the price doesn't glide. It gaps. It snaps. Now, does that mean silver is going to the moon? No. Silver is famous for punishing certainty. But the fundamental setup explains why silver is capable of these sudden repricings. It's not just hype. It's a market with industrial consumption, imperfect supply response, and investors who show up in waves. So when you see silver wake up like this, you pay attention. Because it's telling you something about the stress level in the broader system. We've seen this exact pattern before. Let me take you back to 2020, because it's one of the cleanest examples of how silver can behave when the world is rethinking risk, money, and liquidity all at once. In early 2020, silver got hit hard. It didn't act like a safe haven in the first wave. It acted like a liquidity asset. People sold what they could, they deleveraged, they raised cash. Silver dropped fast because when the system is under stress, silver can get thrown out with everything else. Then something changed. Once the policy response started to become clear, once markets realized the backstop was real, once the fear shifted from everything collapses to we're going to print and stimulate, silver flipped. And when it flipped, it didn't creep higher. It launched. That was the pattern. Violent sell-off, then violent reversal, then a repricing that shocked people who assumed silver was just another commodity. Now think about what's similar today. We're in another period where the rate path matters more than almost anything. The market is hypersensitive to whether policy stays restrictive or starts to ease. And confidence in the system isn't a straight line, it swings. When investors start to believe that tight money is peaking, hard assets tend to get a bid. Gold gets the steady allocation. Silver gets the speculative burst. In 2020, the difference was the speed and size of the policy response. It was dramatic. It was obvious. Today, the market is more conflicted. It's not a straight panic then print story. It's a tug of war between inflation concerns, growth concerns, and policy credibility. And that tug of war creates exactly the kind of environment where silver can do this. Rip higher, pull back, rip higher again, because traders keep getting caught leaning too far in one direction. Here's another similarity from 2020, the importance of hold behavior after a big day. In 2020, the moves that mattered weren't just the up days. It was what silver did after the up days. Did it hold the gains? Did it build? Did it keep attracting buyers on dips? That's what told you whether you were watching a dead cat bounce or the beginning of a true repricing. So if you want a clean mental model for the next couple of days, it's this. Big up move is attention. Holding the up move is confirmation. Giving it all back is a warning. And the reason I'm bringing this up is not to claim we're repeating 2020, tick for tick. We're not. But the psychology is similar. The uncertainty is similar. The positioning traps are similar. Silver doesn't need a perfect story. It needs the crowd to be wrong-footed. And it needs liquidity to be just thin enough that the price has to jump to clear the market. That's exactly the kind of tape we're watching right now. Let's make this personal. Because if you're watching silver and gold, you're not doing it for entertainment. You're doing it because you're trying to protect your purchasing power. You're trying to make good decisions in a world where the rules feel like they change every quarter. Here's what today's move actually means in real dollars. If silver is up about $1.87 in a day, and you hold 100 ounces, that's about $187 of movement. Not life-changing, but it's real. If you hold 500 ounces, that's roughly $935. If you hold 1,000 ounces, that's about $1,870. And if you're holding a mix, maybe some physical, maybe an ETF, maybe some miners, these kinds of moves can swing your account value fast enough to mess with your emotions. That's the danger. Because what most people do after a big up day is they chase, or they get euphoric, or they start projecting a straight line. And what most people do after a big down day is they panic, or they capitulate, or they swear off the asset forever. Silver is designed, by its volatility, to make you do the wrong thing at the wrong time. So the real question isn't, did silver go up today? The real question is, can you stay rational while it's doing this? Now let's talk about the broader portfolio. If you're sitting in a traditional stock and bond portfolio, precious metals often act like an emotional hedge and a regime hedge. Not a perfect hedge, not an always hedge, but a hedge for certain types of scenarios. Currency trust issues, geopolitical shocks, policy credibility cracks. When metals move while everything else is uncertain, it can be a signal that the market is repricing risk in a way that won't show up immediately in the headlines. And here's the contrast that matters. Smart money moved before the crowd noticed. When institutions start building exposure, they're not doing it because they know the exact top or bottom. They do it because they see the distribution of outcomes changing. They see the risks stacking. You don't need to predict silver perfectly to learn from that. You just need to notice when the behavior shifts. And today, the behavior is telling you silver has become a hot instrument again. That can be opportunity, and it can be danger, sometimes in the same week. So your job is not to guess. Your job is to define what you're watching next and how you'll respond if it goes your way or against you. That's how you survive silver. Look, the question isn't whether we see more volatility. The math is clear. When silver is moving 2 to 3% in a day, while gold is up less than 0.5%, you are in a market that can humble you fast. The real question is, are you positioned for what comes next? Because in every previous regime shift, tangible assets had moments where they repriced sharply, then tested everyone's patience, then repriced again. Some people benefited. A lot of people got chopped up. Right now, silver is around 79.56. Gold is around 49.89. The next week matters because it will tell us whether this was a one-day positioning event or the beginning of another phase where silver starts behaving like it's sniffing out something bigger. If silver holds near this zone and builds, that's one story. If silver gives it all back quickly, that's a different story. And I'll be covering what I'm watching in real time on social media, along with deeper breakdowns for people who want the more detailed version. This is educational content, not financial advice. Do your own research, consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. but the data speaks for itself. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of this week? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops soon, and I'm covering the one indicator that tends to show up right before silver makes its biggest moves. It's flashing again. Last time it did, things got wild fast. You won't want to miss it. See you there.